And Jay, we've been talking for the last day or so about what this means and why, what the problem is they're trying to solve. And I guess the implication is that executives are selling their shares into these stock buybacks. If that's the case, I would assume that this would be something, as a former SEC commissioner, you'd be concerned about. How do you look at this proposal?
Well, Becky, let's break it down before we talk about the combination. And the combination, of course, of a stock buyback at the same time that executives are selling, is an issue that needs to be addressed. But let's look at buybacks first. Buybacks are an extremely important part of capital allocation across our economy. Restricting buybacks beyond making sure that they comply with anti-manipulation rules and that they're undertaken in a time when there is no material information asymmetry between the company and the marketplace doesn't make a lot of sense. Buybacks are an extremely efficient way to reallocate capital. And nimble capital in America is what has driven our response to COVID. It is what has driven growth over time in combination with nimble labor, in combination with tech, education, healthcare. It's made America what it is. Restricting sort of that reallocation of capital, you need to think long and hard about that. So let's just be straightforward. I'm a big believer in facilitating buybacks by companies in appropriate circumstances. If you're an index investor, it's what you want. You want capital reallocated across sectors over time. If you're an individual marginal investor who might want to reallocate capital, having a buyback program in place is a great way to do that. Okay, now insider sales. Let's talk about insider sales. We have, and I think for very good reason, allocated compensation heavily toward equity. We want to align our insiders with long-term stockholders. At some point, and there's 2 points here, at some point individuals should have some opportunity to diversify away from that equity. You just talked about Fred Smith. I don't know how long Fred's been there. I don't know Fred, but I hope that over time, Fred was able to take some of his equity and diversify as any individual would want to. Okay.
Right. I think that's part of the problem here is they're talking about lockups for 3 years after a stock buyback, which seems like an extraordinarily long period of time. I get the idea that you don't want the insiders who have decided the stock is at a good price and you want to buy back the shares selling their own shares at the same time. That seems problematic to me. But the idea of telling them they can't sell any shares for 3 years after a buyback seems ridiculous, too.
And the SEC is doing a good job. They're looking at 10b5-1 programs and some of the potential abuses in 10b5-1 programs, but I see no problem. And let's say here in the next earnings season, coming into late April, early May, an executive says, you know what, out in July, after the next earnings, maybe out in August, I'm going to start selling shares pursuant to a program that's put in place.
But Jay, you've seen the research. The research is crystal clear. It's empirical. The numbers are obvious. The weighting towards sales during a buyback program by senior executives in corporate America it's not like a statistical anomaly. It's like statistically obvious that there's a problem.
Andrew, that's driven by a number of factors. Companies can't put buyback programs in place until they're in a window period. Okay, very, very good corporate hygiene. You wait until you announce earnings, and executives can't sell unless you're in a window period. So of course there's going to be coincidence between putting in place a buyback program and executive sales. They're both done in window periods, which, depending on the company, over the time that from you announce earnings until you close it, could be a few weeks, could be a month, but you're basically shrinking what would be a quarter of sales or buybacks into a month.
I'm just suggesting to you that if you look at the window periods, if you will, between a company that has a buyback program in place and a company that doesn't have a buyback program in place, most of the studies will show you it's something on the order of 5 times the volume of sales and the number of sales taking place during that period. So the question is, do you want to create any kind of disincentive or incentive so that those shareholders, those executives who are making the decision to buy back those shares are not effectively self-dealing and pushing out their investment for some longer period of time. 3 years may be too long. I'm not suggesting 3 years is the magic number, but there has to be a potentially, I would argue, a different number than where we are today. You agree?
Andrew, what about a decision that I make in April or May that I'm going to sell shares in August or September or later, long before a buyback program may be decided or put in place? And that decision has been already made, and I don't pull it back. That kind of a long-term sales strategy, what's wrong with that, Andrew?